economic consequence of all this, the three lines on this chart, the pinky orange line, is what we were forecasting a quarter ago when we were expecting that the UK electorate, in their wisdom or otherwise, would vote to stay in Europe. That was our forecast for UK GDP. And you can see it slowing even on an in vote. The blue line here is the result of the Brexit vote, and the difference between these two is the marginal impact of having voted for Brexit, basically. It's a dent in growth, but it's not that big of a deal. Slower, but not recessionary. No outright contraction in the forecast period as we see it, not on an annual total anyway. The green line is the darker things fall apart scenario where Brexit is just part of a much wider global story. The other side of this, the flip side of that coin, sterling is falling. Sterling is falling far. And that's going to create inflationary pressure in the UK coming from higher imported inflation. Import prices are likely to rise. It's almost impossible to see another way that could go. And the consequence of that is headline inflation will almost certainly rise. Higher imported prices are deflationary in expectation. You have an impact on the price level in the first round, but down the line, everyone's worse off because of that. Households are earning less in real terms, firms are making lower profits in real terms, and consequently, aggregate demand, domestic demand falls, and therefore inflationary pressure eases. Which means to say you shouldn't be looking at that necessarily as an indication of where inflation is going to wind up in the UK. If anything, it's going to come back to where it started and potentially lower than that as a consequence of higher imported inflation now. Which means the Bank of England, the MPC, should and will, in our judgment, look through that inflationary boost and not budge interest rates.